U.S. stocks fell on Wednesday with tariff fears returning to Wall Street. For more, let's welcome in now Art Hogan, B. Riley Wealth Chief Market Strategist. Art, it is always great to see you on the show. So, Art, we got to start, you know where we have to start, with Jay Powell. Making comments, Art, the market clearly took a leg lower on those comments. He's talking Trump tariffs and generating higher inflation and slower growth. And the markets, Art, I think seem to say, okay, well, if I have a Fed head talk about higher inflation, forget rate cuts anytime soon. But I'm curious, you heard those comments, you were listening, you saw the market reaction. What did you make of it?
Yeah, Josh, I think the major difference here was that the last time Jay Powell talked about the new administration and their policy, he talked about the totality of it and how we had to make sure we thought about less regulation and perhaps lower taxes. And none of that sort of came through in his speech today. As a matter of fact, the fact that he pointed out that the trade policies actually landed at a place that was much higher than they anticipated would likely cause more inflation and slow economic growth, I think caught people by surprise, especially on the heels of Governor Waller's more dovish take earlier last week. So I think you've got a combination of getting sort of caught by surprise on a day where the market was heading pretty significantly south before he even started to talk.
Yeah, I agree with you there. I think the market didn't expect what Fed Chair Powell had to say, and we hoped for a little bit more of a dovish sort of undertone to his speech. But how do you piece this together now with tariffs and what we have going on for the next 90 days, the uncertainty that we already have in the market with the idea that we might not have that Fed put that we were hoping for there?
Yeah, I think that the Chair Powell did a pretty good job of describing what a conundrum we'd be in if, in fact, these tariffs remain at the higher level that they were announced at for an extended period of time. So I think now that we have to start looking forward to some announcements of deals. I think that the White House has to post a couple of victories here, and I think they're going to start to leak out that process. I think we heard some of that from Commerce Secretary today, but I think it's a function of to get stability back in markets and to get some confidence back in markets. We need to hear that we cut a deal with China or India or Mexico and Canada, et cetera. And I think that would start the ball rolling towards there being an exit ramp to this trade war. Right now, we're just not there yet. So I think we're downshifting back to a place where uncertainty is taking over again. And I think the only thing that really takes that away a bit would be to see a couple of trade deals being cut in short order, meaning days, not weeks.
So, Art, as we sit here, I'm just looking at the SPX, 5230. What is the Art Hogan target for 2025? Year in.
Yeah, so our target right now is 6,100, and that bakes in a lower earnings estimate for the S&P 500 at the end of the year than we started the year with. So we took that down pretty significantly from growth of about 12% to growth of about 8%, and put the same multiple that we've seen for the last 5 years on that on a trailing basis. Gets you to 6,100, and that's baking in a lot of positivity around the fact that we can find our way around this trade war and start getting back to focusing on some fundamentals, and even perhaps seeing some of the positive lighter regulatory touch and perhaps lower corporate taxes offset some of the negativity around things like immigration and certainly things like the trade policy. So that's where we are. I think in the near term, you want to look at the lows we put in about 4,800 being hopefully the sort of the support level that we see in the near term. And on the upside of that, you want to see 5,500 probably is where resistance shows up. But by year end, I think if we get out of this quagmire of the trade war, I think we can start heading towards 6,100. We've been there before this year, and it's not a lot of heavy lifting if we get, call it high single digit earnings growth.
And Art, what is your take on earnings this season? Because here we are, and I think we've had some pretty good announcements across the street here, which should have brought some confidence back into markets. Do you think earnings this year actually matter?
Yeah, they do. The first quarter earnings don't matter because they don't really take into account any of the uncertainty around trade and tariffs and higher input cost. So, most companies are going to report that they had a good first quarter, and that's not going to get much of a reaction. And actually, companies are going to either be opaque, withdraw guidance, or as we saw earlier today, give you a couple different kind of guidance. If in fact we go into recession, here's what we're going to earn. If in fact we get back to the pace of growth that we had at the beginning of the year, this is what we'll earn. So that's going to be the interesting dynamic. And so far, the market hasn't really punished companies that have actually given conservative, opaque, or even pulled guidance. I don't know if that will continue over the course of the next 2 weeks, but for the first 2 weeks, it's been okay to say we really don't know because, quite frankly, if I'm running a company, I probably don't know what my earnings are going to look like in an environment where I don't know what my input costs are going to be.
Art, as we're talking here, stocks, accelerating losses. The Dow's down 960 points now. The S&P 500 is down more than 3%. Viewers are wondering, what do I do with my money here? You argue what they should be thinking about is a kind of barbell approach, Art. What is that barbell? Define it for us.
Yeah, the barbell approach actually on one side has things that we need versus things that we want, right? So, and the market's been acting that way, right? You know, you're seeing the outperformance of things like staples and healthcare and energy and the like. And I think that will continue to be that defensive posture this year. And I think on the other side of that, you can still market weight, not overweight. And everyone's been overweight if you've been involved in any technology, communication services, or consumer discretionary. So I think that offsets and gives you a bit of diversification. I think that will continue to work and probably outperform just owning the S&P 500. Another way to say that would be, as opposed to owning the S&P 500 index, you might want to take a look at the equal weight. So I think that's where a lot of the earnings growth is going to come from. A lot of the underperforming sectors from last year are really outperforming this year. They likely will continue to do so.
Art, we're always lucky to have you on the show. Thank you, my friend.